I'll begin now with the explosive high-retention intro, strong first 4 minutes. No fluff, immediate tension. Then I'll wait for your signal to continue with the 3,000-word institutional body. After that, I'll deliver the extended strategic outro. Here we go. 3 things just happened. And if you only read the headlines, you miss the real story. First, silver violently reversed after a sharp percentage crash that shook out leveraged traders. The price didn't just bounce. It snapped back into a structural range that matters. Second, China made a move that directly affects global silver flows. Quietly, strategically, and the implications are not priced correctly. Third, political rhetoric escalated at the highest levels in the United States, with former President Donald Trump reintroducing trade aggression language that markets have learned not to ignore. And sitting underneath all of it, COMEX positioning is expanding again. Open interest is climbing while registered inventory remains finite. That combination is not automatically explosive, but under the right conditions, it can become combustible. Now here's what most financial media is doing. They're treating these events separately. They're covering price volatility as a technical story. They're covering political rhetoric as noise. They're covering China as a demand headline. They are not connecting the structure. And structure is what matters. Let's zoom in. Silver recently experienced a measurable crash percentage that flushed out late longs. Liquidations cleared leverage. Funding cooled. Sentiment reset. That reset is important because when markets crash and immediately rebuild positioning, it often signals underlying structural demand rather than speculative froth. Now layer in China. When China adjusts scrap policy or procurement behavior, it doesn't simply affect domestic recycling. It alters global flows. Scrap silver is secondary supply. If scrap is withheld, restricted, or repriced, global refiners feel it. If refiners feel it, industrial buyers feel it. And if industrial buyers feel it during a period of rising geopolitical tension, volatility multiplies. Now add politics. When Trump reintroduces aggressive trade rhetoric, whether you support it or not, markets remember 2018. Tariffs altered supply chains. They raised input costs. They forced hedging behavior. If rhetoric turns into policy, it doesn't just hit equities. It pressures metals differently. Because silver is not just a monetary metal. It's industrial. It sits in electronics, solar infrastructure, military systems, AI hardware. Trade friction changes pricing power. And now we arrive at the pressure point. COMEX, the futures exchange, where paper silver contracts represent multiples of available registered metal. Most contracts settle in cash. That's normal. That's not a conspiracy. But when open interest expands into key delivery months, while geopolitical tension rises and physical flows tighten, the probability of stress increases. Not certainty, probability. And there's an upcoming date on the calendar, a delivery window, an expiry, a moment where positioning must resolve into either rollover, cash settlement, or physical demand. That timing matters because markets do not explode randomly. They explode when structure meets catalyst. The thesis here is not that silver is guaranteed to $100. The thesis is that volatility regimes shift when policy, politics, supply mechanics, and derivatives align. Right now, alignment is forming. The crash reset leverage. China adjusted flow dynamics. Political rhetoric raised trade uncertainty. COMEX open interest is rebuilding. And an upcoming delivery cycle sits directly ahead. You are looking at a potential compression phase. And compression precedes expansion. In this video, I'm going to connect every piece. Government behavior, corporate evidence, futures math, delivery probabilities, supply versus demand reality, and the strategic timing around the next key date. No hype, no exaggeration, just structure. Because if silver is heading toward a major repricing event, it won't be because of one headline. It will be because the system tightened quietly. Let's break it down. If silver were simply reacting to headlines, the move would have faded. Instead, after the recent crash percentage wiped out leveraged longs, something different happened. Volume shifted. The liquidation phase showed forced selling, funding rates normalized, weak hands exited, volatility spiked. But the rebound didn't come from retail euphoria. It came during low-drama sessions. That's accumulation behavior. When markets fall hard and then stabilize without media enthusiasm, that's often stronger than a vertical breakout, because it suggests structural bids underneath the tape. Now, let's isolate the crash. A sharp percentage drawdown in silver does two things. It reduces speculative positioning, and it transfers contracts from weak hands to stronger capital. That matters, because the next move in any commodity is determined not by price alone, but by who owns it. If fast money dominates, volatility remains fragile. If stronger hands absorb inventory after a crash, upside convexity increases. The positioning data shows leverage reset, but open interest didn't collapse permanently. It rebuilt. That tells you participants are not abandoning the metal. They're repositioning. Now step outside the U.S. China's scrap dynamics are not a minor footnote. Scrap represents a meaningful secondary supply channel for silver. When scrap flows decline, global availability tightens. When scrap is repriced, refiners adjust output. When refiners adjust output, industrial procurement desks recalculate sourcing costs. And silver is not an optional input in many industries. It's conductive. It's efficient. It's embedded in solar panels, EV components, semiconductors, 5G infrastructure. If China signals scrap tightening while geopolitical rhetoric increases trade friction, that's a layered constraint. Constraint in commodities changes volatility structure. Now let's talk about rhetoric. Markets don't react to speeches. They react to probability shifts. When Trump escalates trade language, markets don't assume certainty. They assign probability to renewed tariff regimes. Tariffs increase input costs. Input costs affect margins. Margins affect capital allocation. Capital allocation affects hedging demand. Hedging demand affects derivatives positioning. See the chain? Politics flows into futures markets. And silver is uniquely sensitive because it lives in both monetary and industrial ecosystems. Gold responds primarily to monetary policy and real yields. Silver responds to monetary stress plus industrial momentum. So when political rhetoric increases trade uncertainty, silver doesn't just hedge inflation. It hedges disruption. Now look at COMEX. Most people misunderstand this. They hear paper silver and assume manipulation. That's simplistic. Futures markets exist to provide liquidity. The leverage ratio between open interest and registered inventory has always been high. That's by design. But stress emerges not from leverage alone, but from timing. If open interest expands into a delivery month, while geopolitical risk rises and physical tightness increases, traders must make decisions. Roll forward, close out, stand for delivery. Each path carries cost. If too many choose delivery simultaneously, warehouses must supply metal. They usually can. But the margin for error narrows. Again, not guaranteed explosion. Increased sensitivity. Markets under sensitivity react more violently to small catalysts. Now, consider volatility. Silver historically exhibits higher beta than gold. When gold rises 1%, silver often rises more. When gold falls, silver falls harder. That's its personality. But during regime shifts, silver's volatility expands disproportionately. And we may be entering such a regime. The crash cleared leverage. The rebound rebuilt structure. China influenced supply dynamics. Political rhetoric raised tariff probability. Open interest is climbing ahead of a delivery window. These are not independent variables. They intersect. And markets reprice when intersections align. Now, let's address the $100 question directly. Is silver going to $100 tomorrow? No. Price targets thrown casually destroy credibility. But can silver experience nonlinear upside during structural stress? Yes. Historically, when silver breaks out of compression ranges after volatility resets, the move can be multiples of the initial impulse. That's math. If volatility doubles and positioning shifts simultaneously, price elasticity increases. And elasticity is what produces headlines. The key is this. Are we entering elasticity expansion? That depends on three pillars: policy, supply, derivatives. Policy risk appears to be increasing. Supply signals from China suggest tightening. Derivatives positioning is rebuilding into a key date. That doesn't guarantee detonation. It builds probability. And markets trade probability. The upcoming date matters because time pressure forces decision-making. Expiration cycles are moments of truth. Participants cannot remain indefinitely hedged. They must roll or resolve. If volatility spikes into that window, resolution can amplify moves. Now step back. Silver is currently priced far below historical inflation-adjusted extremes. It is also far below its inflation-adjusted 1980 high. Yet industrial demand is structurally higher than it was decades ago. Solar capacity is multiples higher. Electronics density is higher. AI hardware requires conductivity. Defense spending globally is increasing. Trade fragmentation may increase regional stockpiling of strategic materials. Silver sits inside all of that. So the macro canvas is larger than one crash or one political speech. This is about regime transition. If we are transitioning from a low-volatility globalized trade regime into a fragmented, geopolitically tense environment, commodity volatility increases. Not because supply disappears, but because predictability declines. Silver thrives in unpredictability. Now, add one more layer: the dollar. If trade rhetoric pressures currency stability expectations, metals react. Silver tends to outperform when the dollar weakens, but during systemic stress, it can rise even with dollar resilience if industrial and geopolitical hedging flows dominate. We are watching that interaction closely. Because if silver rises despite dollar firmness, that's structural strength. And that's rare. So what you are seeing is not random price noise. You are watching compression. Compression between policy uncertainty, supply adjustments, political rhetoric, derivatives buildup, and an approaching calendar catalyst. Compression builds quietly until it doesn't. And when it releases, it rarely gives second chances. Now, we move into the institutional layer. We move from narrative to math, from rhetoric to balance sheets, from headlines to contracts. Because if this is a potential detonation phase, the evidence must hold under scrutiny. And that's exactly where we're going next.